Thanks for joining us today on the 5th of May 2020. You're listening to Ainsley News. And remember, you can always read our news online via ainsleyBullion.com.au. Today we're talking about the Y-shaped recovery and record market concentration. Given the unprecedented nature of this economic crisis, experts are understandably split on what the other side of it may look like. The question of whether there will be a quick V-shaped recovery, slow U-shaped recovery, fast start W-shape, or Japan-like decades-long L-shape remains at large until hindsight provides the only accurate answer. More immediately, the biggest question is how deep we get before any turn back. That too will only be clear in hindsight, though we clearly have a lot deeper to go yet. Probably the least discussed is the Y-shaped scenario, one where the market bifurcates, with part of it rebounding while the rest heads down, with the implication being the down having no end in immediate sight, being a vertical element. The thesis goes that some businesses, big ones who opportunistically gobble little ones with spare cash or cheap debt, or others that thrive in the effects of the virus shutdown, rebound while the rest collapse under a snowball of insolvencies. Note that we're talking about businesses there, not markets per se. Whether related or not, whether prescient or not, we are seeing some unprecedented Y-shaped action in the world's largest share index, the S&P 500. Goldman Sachs recently reported that in the biggest share market index in the world, just 5 companies comprise 20% of the entire index market capitalization: Facebook, Amazon, Apple, Microsoft, and Google. The so-called FAAMGs, or FAANGs, FAAMGs, have now formed the highest concentration ever. You may recall what happened the last time this happened, when everyone was all in, and this time it's different, tech stock of the dot-com bubble. Just showing you Exhibit 4, the concentration of market cap in the largest stocks have soared. Goldman said such lack of market breadth is always resolved in some way, where narrow rallies lead to large drawdowns, as the handful of market leaders ultimately fail to generate enough fundamental earnings strength to justify elevated valuations and investor crowding. In these cases, the market leaders catch down to weaker peers. This is now showing Exhibit 2. Market breadth has reached the narrowest level since the tech bubble. The report goes on to know that the FAAMGs have collectively rebounded to be up 10% for the year despite the COVID-19 correction, whereas the remaining 495 companies are still down 13% despite the bull trap bounce. More broadly, the S&P 500 is down 14% from its February all-time high, whereas the median is down 23%. Such is the impact of those big 5. Whether this phenomenon reinforces the Y-shaped recovery thesis or is coincidental will only be known in time. What's potentially more immediately concerning is, as Goldman's point out, that history tells us such drawdowns are usually a precursor to a broader market correction. There is also a concerning concentration within this concentration. Just 10% of the US population own 84% of all shares held. More broadly, the top 0.1% own more of the total US wealth than the entire bottom 80%. This therefore makes the depth of market participants combined within the breadth of the market itself a potentially perilous combination. And thanks for joining us for news today. We look forward to catching you tomorrow.